Okay, so we're looking at the cost of debt, which is just telling us the cost of debt financing which a business incurs whenever they take on debt. All right. Yes. Then the other way to look at it, it's also the minimum return required by the providers of the debt financing or the lenders. That's what the cost of debt is. All right. So debt, cost of debt is in two forms. Okay, you've got redeemable debt and you've got irredeemable debt. All right, redeemable debt, it means that debt matures. Okay, it has a maturity date, and when that debt matures, you get paid. Most of the times, you get paid the par value of the debt. Okay, then irredeemable debt, it means the debt has no maturity date. Okay. The debt has no maturity date. Okay. So it means you just be getting interest payments. The debt won't mature. Okay. So we're going to look at how we can calculate the cost of debt, looking at first irredeemable debt. Then we're going to look at redeemable debt. Okay. So let's start with irredeemable debt. All right. This means the debt has got no maturity date. Okay. Yes. So here's the first example. Jansa Limited has 100,000 kwacha of 10% irredeemable debt. Okay. So on the balance sheet, okay, on the non-current liabilities, this debt, this is the amount that is the 100,000 kwacha. Okay. 10% irredeemable debt. This is the interest rate of the debt, this 10%. Okay. So Janza has 100,000 kwacha of 10% redeemable debt in issue, which has a market price of 950 kwacha per 1,000 kwacha of nominal value. So colleagues, what this sentence is saying here, when we say 950 kwacha per 1,000 of nominal value, it means the nominal value of the debt is 1,000 kwacha. The amount you pay for the debt, it's 950 kwacha. And remember, when the market price is less than the nominal value, it means the debt is trading at a discount. Okay, the debt is trading at a discount. Okay, so with this debt, okay, yeah, the debt is trading at a discount. Okay, and they've told us the corporate tax is 30% per year. Okay. So this debt has got no maturity date. Once you just buy it, you'll be receiving interest payments. Interest payments. It won't mature. You won't be paid this 1,000 kwaj. Okay. If it was redeemable, then it would have meant after when the maturity date comes, you'll be paid this 1,000 kwaj. But since it's not redeemable, so you're not going to be paid this 1,000 kwacha. You just pay this 950 kwacha and you'll be receiving interest payments in perpetuity. Okay, and then they've told us corporate tax is 30% per year. All right, so the first thing we need to find is what is the cost of debt capital? Okay, what's the cost of debt to this company? All right, then they want to ask us also what is the return to the investors? Okay. So if you're ever faced with this scenario, here when they're asking what is the cost of the debt capital, you're looking at it on the business side. Right? Then here, what is the return to the investors? This is on the investor side. Okay. Yes. Most of the times, the questions you'll be dealing with them on the business side. But I just want to show you in case they brought for you where they ask you what is the return to the investors. So this is the formula for the cost of irredeemable debt here. You see, KD equals I. I represents the interest payments. 1 minus T. Remember, this 1 minus T implies that whenever a company takes on debt, it pays less taxes, or it saves on taxes. That's what this 1 minus T is implying. That if you're a company and you take on debt, you're going to pay less tax, or you're going to save on taxes. All right. Then the MV here is just the market price of the debt, how much you're paying for the debt. Okay. So this is the formula that you need to remember. It will not be given to you in the exam, so you need to remember this formula. So always with debt, the first step is you calculating the interest payments first. Okay. You can find out, okay, what are the interest payments that this company has to give out? Okay. So the interest payment, you just is the way you get it is the interest rate times the par value or the nominal value. Okay. In the question, we've seen the interest rate here is 10%. Par value 1,000 kwacha. All right. So the interest payment, 10% of 1,000 kwacha, that is 100 kwacha. Okay. That is the interest payment. Now we must remember, as this company is paying interest to the debt holder, it's saving on tax. That's why we're doing this 1 minus T. As the company is paying interest, it is also saving on tax. Okay. So once you get the interest payment, you multiply it by 1 minus T. T is the tax rate. They told us the tax rate is 30% per year. Okay. So that 30% is going to be put as 0.3 here. Okay. So 100 kwacha, the interest payment, which is I, multiplied by 1 minus T, which is the tax rate, divided by the market price of the debt, which is 950 here. Okay. So you're going to say 1 times 0.1 minus 0.3, that is 0.7. 0.7 times 100. Let's get our calculators, colleagues. 0.7 times 100, that is 70 kwacha. So that will be 70 divided by 950. Then 70 divided by 950, 0.00736. Multiply this by 100%. The cost of debt to the company is 7.37%. Okay. Which is also called the after-tax cost of debt. Okay, you will hear this term, after-tax cost of debt. Okay. Any questions? Okay. Now, when we ask what is the return to the investor, basically we're asking like what's the interest rate the investor will be receiving. It's the same formula. The only difference is we ignore this 1 minus T because this investor is not saving on any taxes, or is not paying any less taxes because of the debt. It's the company that's enjoying that, not the investor. So the investor, the formula, you just ignore this 1 minus T. Okay. I, the interest payment, 100 kwacha. MV, the market price. So 100 divided by 950 kwacha, 0.105. Convert that into percentage, 10.5%. Okay, that is the return to the investor, the one who buys the debt. That is their return. So, as I said, this one was just for your general knowledge sake. You rarely see these ones here. What you'll be examined on is the after-tax cost of debt for the company. So this is the one you must focus on most. The after-tax cost of debt for the company. Okay. Yes. Any questions before we move further? Okay. So this debt is redeemable, meaning you pay. So the story goes like this: you're going to pay 950 kwacha, and then you just be receiving it. Year one, interest payment of 100 kwacha. Year two, interest payment 100 kwacha. Year three, 100 kwacha. Okay, it will just be going on. The debt won't mature. Okay, you just be getting your interest payment 100 every year, 100 kwacha, 100 kwacha, 100 kwacha, 100 kwacha. Okay, that's how irredeemable debt works. You just buy it and you just be receiving interest payments. Okay, example two. Now, this one I would like you to try example two. Okay, with your papers and pens. Then we leave. Janza Limited has 500,000 kwacha of 12% irredeemable debt in issue, which has a market price of 950 kwacha per 1,000 kwacha nomin. Corporate tax is 30%. Okay, calculate after tax cost of debt. Oh, and colleagues, sorry, I forgot to also mention one thing. This one here for this return to the investor, in case you are asked the pre-tax cost of debt. Okay, for a redeemable debt, you can also use this one. They might not say what's the return to the investor. They might ask you what's the pre-tax cost of debt. But as I said, it's rare in your for at once for whether your question on pre-tax cost of debt. But if you should you be asked about the pre-tax cost of debt or the return to the investor, just for irredeemable debt, just know you're using this formula and excluding 1 minus t. Yes. So can we try this question here? Calculate the after-tax cost of debt. Here's the formula here. Get the interest payment. That's the only thing you need to tabulate. Interest payment. Then you plug in and tell me what values you get. Yes. So try to calculate that. Then you tell me your answers. Then you compare answers. If you still need guidance, you can ask me where you are getting confused. I can assist. But the main thing is I want you to try so that we see if we're understanding what's happening. I urge everyone to attempt. Okay, attempt. Try this. Try. See if you can get it correct. Has anyone calculated the interest payment? What's how much is the interest payment? Oh, you are breaking. Yes, yes, Mr. Simon. That is correct. Is everyone else finding 120 as the interest payment? Yes, Madam Beverly, are you finding it as 120? Okay, wonderful. That's wonderful. Madam Diana, Madam Liana, Mr. Mpasa, and Madam Tandi, are we finding 120 as the interest payment? Wonderful. Madam Liana, wonderful. Madam Liana, okay, we are winning. This is good. Okay, so once you get the interest payment, just do the this. So interest payment, open brackets 1 minus T. Remember, when a company takes on debt, it means it's saving on taxes, and you divide by the market price. What is the market price here? Correct. Yes. All right. Colleagues, do you know how to tell if debt is irredeemable? Because in the questions, they are not going to tell you that this is redeemable. Do you know how to tell if the debt is irredeemable? The way you tell if debt is irredeemable, on the question, there is no maturity date. Okay? If you please take note of this. If you do not see a maturity date in the question, have you seen like even in this question, when we say the bank told us after 5 years, the debt matures after 5 years, or whatever, it's silent. Then you know you're dealing with irredeemable debt. If they do not mention anything of maturity, a maturity date, then you're dealing with irredeemable. Okay, we can share the answers. I believe someone has got an answer. What answer have you got? 8.8. Okay. Anyone else finding 8.8? I think that one is correct. What are the others finding? Before I show my workings. Yes, 8.8%. Okay, interest payment, interest rate times par value, 12% of 1,120. Okay, then just 120, open brackets, 1 minus the tax rate, which is 30%, becomes 0.3 divided by the market price, 950. Then 120 times 0.7, you get 84. 84 divided by 950, you get 0.088. Convert it into percentage, 8.8%. Do we have any questions, colleagues?